Okay, so I just want to do a quick summary in regards to some stocks. I've had a few people messaging me saying, "Oh, is this a good buy? Is this a bad buy?" For example, this one here, this is CSL Limited, the biotech company from Melbourne. And you can see the stock peaked up here. It's come back down. It's found some supports, come back up, peaked with a lower peak. It's come back down, but it's found a resistance level here. And you've got a trend line that's been going up. Now, I've heard arguments saying, this is just an example, but other stocks as well, where, the trend's going up and it's looking brilliant. I mean, in this case, it's broken down, so I'll probably be looking more for a retest of this trend line and a move lower. However, people seem to forget about the bearish side and just think about buying. What I always say is, look on the different time frame. From this, you can be forgiven. You can be thinking, oh, well, you know what, that's fine. But even if it does go down to, say, here, I don't know, 220, eventually it's going to go back up again and everything's brilliant. There's not a problem. What people aren't doing is they're not looking on the longer term, which is if I go onto the weekly candle here, you can see the price now compared to where it was back in 2012. If I just zoom that, yeah. So if you think that is a good buy up here, when this is your long-term trend line and your price to earnings ratio according to them is, I think it was, I've got rid of the screen now, but it was 43, I think, maybe a little higher than 43 for 1% dividend payment as well. Not particularly a good buy in my book. So the whole point is that you don't buy the peak, you buy the bottom. It's not to say it's going to go all the way down to this trend line, but at the moment, whilst we're up here, and you can see this consolidation pattern now, I'm going to be looking for stocks potentially to at least go down to here. At some point, reality is going to set in and we're going to get a sell-off and things are going to head lower. Now, okay, maybe central banks do jump in and they start actually printing real money and just giving it out for free, which causes this, potentially causes the crash to stop. But whilst it might stop, what you're going to get is you're going to get inflation whilst the stocks remain stagnant, and you don't get any real growth. I mean, eventually, yeah, okay, it might go up here, but it can take decades for that. And as a prime example, no one's done more quantitative easing than the Japanese. And this is the Nikkei 225, which peaked here at 39,304, so just short of 40,000 yen back in December 1989. It's then worked its way all the way down, despite QE and QQE and everything else under the sun, and is now, today, and after a major breakout, after this, is now up to, well, the current price today is 28,392. So there's a 10,000 yen difference here between the stocks if you bought the peak up here compared to what it is now, and this is a 32-year gap now. Not to mention the fact that arguably in this time, people are going to argue that we've had inflation. The stock doesn't necessarily show that with it going down, but assuming that we've had price inflation and everything else, wages have gone up, yet the price of the stock is still 10,000 yen less than what it was 32 years ago. That to me is not a good buy. I wouldn't want to have to buy something and wait 32 years to, still not even get my money back. I could be waiting even longer still. That's just my thoughts.